Corporate finance, inventory financing. Our business skills will advance because we use corporate finance. Inventory financing. When thinking about short-term financing options, we're typically thinking about loans, but also note, as we looked at in prior presentations, we can think about things such as accounts receivable and how we might use accounts receivable as a current asset to possibly support us in our financing in order to increase the cash flow. Idea being that if we increase the cash flow with the short-term financing, we can reinvest that into the business and grow the business faster. So if we're in a growth point in the business and we need cash flow to continue to grow, possibly investing in more machinery or in more inventory or something like that, then we're looking for ways to increase the cash flow, increase the financing so that we can then do so. When we're talking about inventory, we're talking about things that we have on the books that we intend to sell in the future. And the reason we have those items, those inventory assets, is in order to sell them in the ordinary course of business, generating revenue, which hopefully will generate cash flow, but not until the future. And it might be some time till we get the cash flow because we have to sell the inventory. We might then sell it on account, and then we might have to then collect on the accounts receivable, finally getting the cash related to the inventory at some point in the future. So then the same kind of questions come up as with the accounts receivable. If we want the cash flow sooner and we can utilize those assets basically in some way, shape, or form to increase the cash flow, it might be worth doing because then we can take that cash flow and reinvest it and hopefully generate returns on it. So that's going to be the idea here. Items that can impact the use of inventory financing include the marketability of the goods being pledged. So when we're thinking about the inventory being pledged basically as something like collateral possibly to increase the financing options, then what's the marketability of those goods? The price stability. So obviously if you're a financer, then you're thinking about how stable is this thing that is being pledged in terms of the inventory, whether the items are perishable or not. So obviously when we're talking about things, longer lasting things, if you're a lender and they're basically pledging the inventory, are probably things we might feel a little bit more secure about. If we're talking about things that could expire shortly, then it's going to be a little bit more difficult, you would think, in order to get financing with relation to the asset of the inventory. The amount of physical control a lender can have over the product. So then you're thinking about if you're a lender and your inventory is being pledged, then obviously you can have a promise, just simply a pledge, but if things go bad and you have no actual control over the inventory, then you might not feel as secure as if you had control over the inventory in the event that something went bad. But having more control over the inventory, of course, then is costly. It adds costs to do so. So raw materials and finished goods generally are the best collateral. So when you're using inventory in order to help generate short-term financing as a kind of collateral, if you're a manufacturing type of company, then obviously you got three components of inventory. You've got the raw materials, you got the work in process, and then you've got the finished goods. If you're a lender then, and the inventory is being used as collateral to support short-term financing, then you're probably fairly comfortable with the raw goods. Like if you're making guitars, for example, and they have just wood, well, we know what the cost of wood is. It's pretty straightforward. It's a raw material item. So I can be fairly confident about the value of that. The finished goods, hopefully they have added value then, including labor, overhead, to get the finished goods, in this case a guitar. Again, we can be fairly certain at least of the value of the guitar if it's finished. But if it's in process, if you got a piece of wood that's glue on it or something like that, as a guitar might be in process, then that's pretty worthless. It's no good as wood anymore, and it's no good as the finished good. So it's probably going to be less, something that we're less secure with as a lender, as a supporting item for short-term financing. So work in process may only qualify for a small percentage of the loan, most likely. Lender control grants higher assurance to the lender, but increases admin costs as well. So once again, if you are the lender and they're using basically inventory to help secure loans for short-term financing that is being loaned, then they could just say, hey, look, we're just going to pledge the inventory. They could say it's a blanket inventory liens that you have on it in the event that there's a problem with the loan or default on the loan. The lender only has general claim against the inventory. So that's great because in theory, then the lender is secured. But they don't have any physical control over it. So if there's a problem, then it's going to be difficult for them to exercise the actual control over the inventory, even though they may have, say, the legal right to do so. So a trust receipt, that's where proceeds from sales in a trust for the lender. So that could add a level of control because the proceeds will be in the trust that hopefully will, have control for the lender. And then warehousing, then more physical control. Goods can be moved only if the lender approves. You could have public warehousing where you have a warehousing firm, or you could have field warehousing using the borrower's premises for the warehousing. So the warehousing is going to give the most control here, or more control, but that's going to add to the costs because then you're going to have to go through this process of the approval process and whatnot for it. So it's going to be costly on the admin side of things. So to have good control measures then, if you're going to have good controls over this process, high levels of administrative costs are required. And high levels of administrative costs are obviously going to add to the total cost that will be overall. The overall costs of borrowing generally increase because obviously those admin costs need to be covered. And then the providing of funds should line up with the needs of the company. So the goal of the financing is going to be, once again, if you've got the assets of inventory, what we would like to do is get the money as soon as possible on the assets of the inventory. We've got the inventory, the idea being, look, the inventory is here, the inventory has a value to it. All we want is to get the funds sooner because we're in a state of growth and we would like to get that short-term financing as soon as possible because the faster we get the cash flow, the faster we can invest it back into the company, possibly purchasing things like machinery and equipment to produce faster or in some other way feeding it back into the company. So if you're in a growth state within the company, then the idea would be it might be worthwhile then, to add or pay the added costs to basically get the short-term financing from the assets or with the use of the assets that are on the books in the thought that we will get paid for them in the future, but we want to get the financing now and possibly will be willing to then pay the costs in order to do that because the benefits of reinvesting that cash sooner, having the cash flow faster, doing the short-term financing might be worth the cost.